Today I'm going to share with you a brief lesson on investing. So the thing is, when people start to invest, they often get tripped up in psychological behaviors, most commonly. But the best advice that I can give you is to stay logical and use common sense in these cases. I will be discussing some investing tips on this platform as part of what I want to share with you. As a contrarian thinker, I often think of other ways to make money aside from a 9-to-5 job. So some more non-traditional ways. And I think investing is a good way to make some more money on the side. I would say if you are not investing, you are not maximizing your profits because you basically have money that's just sitting in the bank in a savings or checkings account, and you're not going to get that much of a return over time compared to if you invest. So I've been investing since 2020, and if this raises any red flags for you because it was such an uncertain time, I totally understand. But here's the thing. This is your emotions ruling over your logic in this case. 2020 was one of the key times to buy because stocks were at a low. And through research that I did, I knew over time they were going to increase, even though we were at a very uncertain point. Another pivotal time to buy is right now, actually, during these Trump tariffs, because eventually the economy, it will go up, but right now it's an uncertain time. And still, people will see the risk and they should not fear, really. So think of it as a stock on sale. Now, when sales happen, people tend to get excited about what's on sale and maybe they want to purchase a product or so on. But when it comes to stocks, people often fear when there's a sale happening. And that's the time when you want to buy in. I myself have bought into stocks again during all these Trump tariffs that are happening. And I'm not being fearful because I've done my research and I know that it's bound to go up. Because if we look at a chart compared to when I invested in 2020 to 2025 now, it actually hasn't dropped past the point of where I purchased on some of the stocks that I invested in. So let's take Microsoft as an example. So I bought in at the end of 2020, in which the amount was approximately $215 on when I bought in. So if we look at the trend, it is trending upwards. And we can see here, if we go to 2022, there was another crash that happened in which it got pretty close to what I bought in at its lowest point. And then if you continue up to where we are now, we can see it's dropped again, but now it's not hit the line of resistance. I'll explain that in a moment. So basically you have this sitting at today, right now, $359. So you can see in a 5-year span that it has actually gone up over time, which is the point that I'm trying to make. So let's explain the line of resistance. So when we're looking at line of resistance, we're looking at the lowest low and the highest high. So here, if we're looking at a 5-year span of the lowest low and highest high, the lowest point after I bought in is sitting at 224. And the highest point since then is 467. So there you can see some margin in between of will it eventually break past this line of resistance, or will it go down past this bottom line of resistance? Probably not if you keep on looking at the trend. So now that I've given you a background on my investing experience so far, here I'm going to give you 7 tips and quotes on how to start investing, and hopefully these will resonate with you. Quote number 1. Be fearful when others are greedy, and greedy when others are fearful. This is a quote by Warren Buffett to help understand how to invest and a good strategy to follow. So this quote meaning, when people are greedy, that means markets tend to be high because everyone is buying in at the same time. Now, in general, people don't like greedy people. So being fearful would be a good response. The time to invest is when people start selling off. So this is the time when you would want to be greedy in this case. Or if you're already invested, then just keep holding. Quote number 2, time in the market beats timing the market. This means the longer you are in the market shows better results than entering and exiting the market and doing short-term trades. So say you have invested for over 20 years. That means that growth will have accumulated over that time. When you are exiting and entering the market, in the long run, you're more likely to make bad trades because honestly, it's too hard to time the market. Point number 3, bear markets last less time than bull markets. So bear meaning a downtrend and bull meaning an uptrend. To make it easier to remember this, think about it as the scary bear and riding the bull. So that would be the uptrend. So if you average out how long you'll be in a dip versus being profitable, you'll spend more time over time being in profits than you will in losses. Except for when you make a bad trade in which the company appears to be bearish over time. And sometimes that can be hard to come back from that. So to offset your losses, be ready to balance your portfolio. Balancing your portfolio means to invest in other companies so you can counteract your losses. Point number 4, investing is a game of psychology. When investing, people are often too emotional or they get emotions too involved in the process. And you need to remember to stay logical when you're investing. It can be scary to see a dip happen when you're investing, but don't be fearful. And the best thing you can do is hold if you can. It even happens to myself when I've bought in the dip, but then it keeps on dipping lower. And then I start to question myself, did I buy at the wrong time? Should I have bought a little bit later? When really I should be thinking, at least I bought somewhere in the dip. If you are already investing and you're currently in a dip, stay the course and hold to wait for it to go up. Point number 5, as a foundation, start to invest in index funds. So an example of this would be the S&P 500. This is a share of the top 500 companies in the US. It gives you a share of each of the 500 companies, which could be a good place to start out. So it gives you a bit more of a range. To even further diversify, you could even invest in gold and also real estate. Point number 6, as a general rule, is always be buying. Now I said to buy at the dip, which is a good point to buy, but if you're not seeing that happen, it's never a bad time to invest, especially when you see a price that was lower than it was before. If you have any savings, it's better to invest it than to let it sit in the bank because you're not getting a great return from the bank and they know this. And lastly, quote number 7. The stock market is a device for transferring money from the impatient to the patient. And this is a quote from Warren Buffett, meaning don't sell because of fluctuations. Because if you do, someone else will take the profits. Reality is the market will always go up and down, and think about how many times we've had recessions and have bounced back from it. This is an example of when people will become fearful in the market, and you want to take that opportunity to be there and be ready to invest. If any of these quotes or tips were helpful for you today, then feel free to leave a comment and let's start a discussion.